Rate cuts are usually seen as bullish. Lower rates, cheaper money, higher stock prices. But history shows something counterintuitive. Some of the largest market drawdown actually happen after rate cuts. So the real question is, why do some rate cuts lead to rallies while others don't? In this video today, we will help you understand the levers of monetary policy and get a better understanding on how rate cuts impact the market. Hi, I'm CY, and on this channel, I share more on finance and macro deep dives. If you enjoy this type of content, please subscribe to my channel. Now, let's dive in. To better illustrate what I was referring to, let me show you a chart by Goldman, which showcases how S&P 500 typically behaves around Fed rate cutting cycles. It splits into two scenarios. At the top, rate cut with no recessions. In this case, stock tends to rise strongly over the following 12 months. And at the bottom, rate cuts that happen as the economy enters into a recession. Here, stock keeps falling, often another 15 to 20%. Same policy action, but completely different outcomes. These charts prove one thing. Rate cuts alone don't decide market direction. So, what actually does? To answer that, we need to understand the two levers of monetary policy as opposed to just pure rate cuts. The first is interest rates, which is what most people get hyped on. When people talk about rates, they're usually referring to Fed fund rates. This is the base price of money. Lower rates equals to reduced borrowing costs and lower discount rate for assets. This affects how cheap or expensive money is. However, that is just half the picture. What is crucial to understand is the liquidity. Liquidity is how much money and credit actually exists in the market. One simple way to visualize this is global M2 money supply. Global M2 includes cash, checkings and savings deposit, short-term money across major economies. You can think of global M2 as the total pool of money that can flow into global assets. When we look at global M2 money supply, what matters more is the growth rather than the actual amount, as the rate of change tells you how much more supply are being added to the market. As a recap, rates tell you the price of money, while liquidity tells you the quantity of money. Market needs both. Here's where confusion happens. You can have a falling rates while liquidity is flat or tightening. In that environment, borrowing is cheaper, but money isn't flowing and credit stays tight. And when liquidity is tight, risk assets tend to struggle even at a lower rate environment. This is why rate cuts alone are not automatically bullish. To help you understand better, let's look at two different scenarios. Historically, rate cuts fall into two buckets. The first is insurance cuts, such as what we see in 2020 following the COVID-19 pandemic. This is where economy is still functioning, earnings are mostly intact, and credit markets are stable. In this scenario, rate cuts are supported by strong growth in liquidity, which allows market to recover as it supports confidence. The second bucket is what we call emergency cuts, such as what we see during the 2008 global financial crisis. This is where growth are already deteriorating, credit stress are rising, and earnings are falling. In this scenario, rate cuts is not supported by growth in liquidity, and this results in stock continuing to fall due to overall lower confidence. So, a rate cuts can be supportive, or it can be a warning signal. This is why investors zoom out to global M2. When global M2 is rising, risk assets tend to do well. And when it's flat or falling, market tends to struggle. Liquidity works slowly but powerfully. Now here's a framework. When you see a rate cut next time, ask yourself, why is the cut happening? Is it due to insurance cuts or emergency cut? Number two, is liquidity expanding? And number three, are earnings stabilizing? If all three aligns, rate cuts can be bullish. If not, rate cuts alone aren't enough. Rate cut matters, but they're just one lever. Liquidity and earnings decide whether markets actually rise. If you enjoy this type of content, please subscribe to my channel and I'll see you in the next one.